Hey, welcome back to Lunch at the Market. What a beautiful day that is, unless you're looking outside at the weather, which is not so beautiful. All right, the recent run in the stock market that we've seen since the March 15th lows has been absolutely phenomenal. And you know what that means? We're going to have to start talking to you about taking profits off the table. Yep, that's right. Stock markets don't go up forever. And we're approaching the 1330 level, which has been resistance a couple times in the S&P 500. And we see no reason to watch your stocks decline all the way back down to the bottom of the channel. So today we are taking some profits and we're hedging and doing things like that. Basically raising some cash in case we get sell in May and go away. In fact, we're planning on sell in May and go away because we still have our long put spreads on the SPX. If you just type in SPX on TradeMonster, you can pull up the S&P 500 itself and you can buy calls and puts right on the index rather than have to use the SPY or some other instrument on top of an instrument. We'd rather just stick to the index itself. So we're long the 1300 1275 put spreads that expire in May. Ideally, we would have blown out of those when we sold our VIX call spreads and then put them back on right now as we did this week when we put on our long VIX call spreads. So we're long VIX call spreads now out to July, and we're still long our S&P 500 puts, again at the 1300 1275 level. See, basically, when the S&P was selling off before, we only were offered about, say, $13 for what was clearly a $25 wide spread. And we're a little chintzy over here, and we didn't want to let go of our merchandise at a price that we didn't think was fair. So even though we were up 50%, we continued to hold on to them. And now, of course, look where we are now. So the moral of that story is sometimes you have to take the price that you can get. So what we'll do is we'll hold those 1300 1275 put spreads into May, and we'll take action there. We'll either flip them to a short put spread, which gosh knows we've done plenty of those around here, or that we'll get sell in May and the S&P 500 will decline. And if we can get around $20 by options expiration in May, then we'd be perfectly happy to let those suckers go then, as our hedge will have worked terrifically. So be on the lookout as we get closer to May, or if we get a massive sell-off, for what to do with those hedges. But as for now, we want to sit tight because they're a great hedge against the rest of our long portfolio. Okay, so that covers the Standard & Poor's 500 index. Also, just a note on seasonality. If you go back and pull last year's chart up, we actually sold off in a nasty way last January into February and then had a terrific bounce all the way up to about the April 20th highs, at which point sell in May and go away set in about the second week of earnings, and we just sold off endlessly until July. Another reason why we want to have long call spreads out to July and long put spreads at least in May to cover sell in May and go away. So seasonally, we're in a good position to have those hedges on. If the stock market continues to rise, like we said, we'll just convert that into a short put spread by taking the strike that we're long, selling it, and then buying a strike lower below the 1275 puts where we're short. Okay, so that's how that works. All right, now what have we done today? Again, it's all about raising cash. So while it's been a while since we beat the sell, sell, sell drum, we're going to start doing it today because we're up at the top of the range. Again, we continue to take off Netflix, Molycorp, and Freeport-McMoRan short put spreads that we have out there. We have tons of put spreads that we sold earlier. Some of those are a result of rolling down and out from last month's blow-up fiasco, in which it looked great about 10 days before options expiration, only to go the week of options expirations for last month, where the stock market just sold off endlessly until we had to roll most of what we had down and out. So rather than face part two of that story, if we're up 90% or better, we're starting to buy those short put spreads back. And in some cases, as we get towards the end of the weeks, say Friday, and then again Monday and Tuesday, any of those positions that were up 80% or better, we're going to start taking those off as we get closer to options expiration, because this month a lot of the move has been end of the month window dressing, meaning we're getting absolutely terrible macro data coming out, but the stock market continues to power higher. So why take those chances, right? Vegas is far enough away from North Carolina that we don't need to take chances like that. So when we get better than 80% profit on those short put spreads as we get closer to the end of the week, if we can't get them up into the 90th percentile by, say, next Monday or Tuesday, we're going to start buying those back so that we have a limited number of positions still on the table for options expiration. And then, of course, we'll use all the big cash we have piled up from buying back everything else and from selling our hedges to manage the trades into options expiration. Inevitably, we will take some position into options expiration. Right now, we just don't know what it is, but it probably won't be Freeport and it probably won't be Netflix. We may take our short 50-45 put spreads for Freeport-McMoRan into options expiration, and we'll probably take our Salesforce.com 120-115 put spreads into options expiration. Both of those will hold short. All right, BHP, that's the other name that we said we were going to talk about specifically today. We are long January 2012 deep in the money calls, but we're up about 35% on that position, and the stock has really ramped quite a bit. And we were actually able to sell the May 95 call against our already deep in the money call out to January 2012 for $360 per call. That's quite a premium for basically, it's about 50 cents away from where the stock is right now. We're actually perfectly happy to be called away because, in effect, by getting $3.60 for selling that option, our effective price that will be called away is about $98.60, which is way above where we bought the in the money call to begin with. And so the end result of it, if we get called away in May, will be about up 60% rate of return, and we've only held the options for a couple months. No shame in that game. Nobody ever got hurt taking a profit. So that's what we're doing. We also turned other long calls out to January 2012 and 13 into effectively what are diagonals, meaning you're long a call farther out of the calendar, and then you're going to sell calls in the front month against it each month to basically create your own dividend until you eventually get called away. Once we get up around 25-30% in a position, we like to start doing this. I noticed that John Najarian is a big fan of when he's got a big winner, he'll actually sell a slightly in the money or at the money call against his position to try to get called away so that he goes into the next month with a very small portfolio. So that's what we're employing today. So Solutia, SOA, BTU, which is Peabody, SLV, we already gave you that trade. Oh, we didn't give you the SLV trade. Aha. Silver, we are long January 2012, 25 strike in the money calls in silver. Again, we're up about 35%, and so we sold the May 38 strike against that for $1.46. Again, a lot of people are calling for SLV to get to 40. We don't necessarily need to catch the absolute top tick, so we've already started selling those. We've actually sold May 38 strike calls against every single long January 2012 25 strike call that we're long. Okay, so we've got a deep in the money call out to January 2012. We're going to start selling front month calls against it until we get called away. The $1.46 is about 50% of the profit that we have on the reduced SLV call position anyway, and so we're really juicing those returns by trying to aggressively sell calls against it. We're not trying to shoot the moon. We don't want to sell an at the money call, and we don't want to sell a 40 strike call because we're basically attempting to sell it for what everyone thinks will be the high in SLV anyway. All right, if you have any questions, just mention us on Twitter at MO Financial. Write some comments on the YouTube channel for this video, and don't forget to be on the lookout for a new episode of America's Favorite Traders. Tomorrow we have a brand new guest on America's Favorite Traders. As soon as the episode is in the books, we'll let you know tomorrow on Twitter who we had on our show, and then we'll try to have the episode out by next Monday. So enjoy your afternoon, take some profits off the table, and go buy yourself a nice sweater. No one ever got hurt taking a profit. Have a great day. Be on the lookout for new America's Favorite Traders, and we will see you tomorrow.